Great, thank you. Good morning, everyone. So, many companies here covering many different commodities. One thing that's common to all of them is the wider commodity cycle. So I'm going to talk over the next kind of 15, 20 minutes or so about where I see us in the wider cycle, some of the themes that are coming through, how they affect things, and also we'll leave a bit of time at the end for some question and answer. So, commodity prices have done pretty well over the past 2 years. We've been in a good environment where global industrial output has been rising quite strongly. We've had that recovery from what was in the nadir at the start of 2016. And it first was led by China, and then it's spread out through the rest of the world. And that's been the key thing. Demand always leads commodity cycles, and we've been in a pretty good demand environment. Now, supply normally reacts to that. After prices rise, you get supply reaction. This is what's missing. We haven't seen the same supply reaction for a number of reasons across these commodity markets. I would particularly note that the clampdown on private sector mining in China, now we've relied on that as an elastic buffer across many commodity markets over the past 15 years or so. Well, we all know that they've taken capacity out of some of the more polluting downstream industries, but the clampdown on the private sector mining side, I think, has been equally as impactful on global market dynamics. And for many of these commodities, if we look at the commodities that have done well this year, the vanadiums, the molybdenums, the manganese ores of the world, they've all been ones that are heavily exposed to the Chinese private sector. So for me, that trend has been interesting, and it means now that China has been helping from both the demand side of the equation, where demand has outpaced expectations, and also from the supply side. We're still looking in commodity markets for those where we're getting bottlenecks. Where are we not going to get enough out the ground? That's still obviously where you get the best pricing dynamics. But increasingly, actually, we've seen situations where the world relied on China to export some refined products, in many cases now, because we've seen the clampdown on some of this capacity, we're running into bottlenecks there as well. So where we got used to Chinese exports and they're not coming through at the same pace, well, that's added a new string to the bow, if you want, for commodity markets. Just put up there the price performance over the past 365 days. And you can see, without explaining the chart, the blue line is basically where we are. The light blue is where the range has been. All commodities, with the exception of silver and platinum, are up on where they were this time last year. So it has been a good environment, and to me, say the demand side has played part of that. We've also got wider pressures coming through. Of course, oil is basically at $80 a barrel today. That served to start to see cost structures increasing and slightly higher support floors for many of these commodity markets. Okay. You can't talk about commodities without talking about China. Now, the Chinese economy is a very different one, if you want, even to what it was 2 years ago. If we remember back the dark days, if you want, of 2015 into early 2016, that's when analysts and myself were concerned about Chinese debt. That Chinese debt's still there, but what's been successfully done is the problem with Chinese debt was not the absolute level of it, it was the concentration of it. It was concentrated in certain industries, and I would say metals and mining was a key one of those. We had seen investment for demand growth that didn't quite come through at the same level. When you had an industry that was highly indebted and starting to cause systemic financial risk. Chinese government realized this. Number one, they've been propping up the demand side, and we can talk about some of the fiscal support levers they've been using. But you've also seen them by controlling the supply side. As talked about before, clampdown on private sector mining, clampdown on the smaller, more pollutive refined capacity. That's allowed this what's effectively a reflation trade to come through, and that spread the debt through the value chain. There's less of a tail risk from China than there was 2 years ago. There's a longer term gain here. It's more power back to the state. What you're seeing is more SOE consolidation coming through, and SOEs taking more control. Now, those Chinese state-owned enterprises are much better run companies than they were 3 or 4 years ago. And what's interesting, we talk about the lack of capex coming through. Well, fixed asset investment in metals and mining in China has been negative for the past 4 years, and that is showing no sign of recovery. China still cares about growth, and it still uses fiscal levers to make sure that if growth is heading towards the downside part of their range, you'll see things pulled. Now, in the old days, of course, that was infrastructure. We used to see fixed asset investment in infrastructure trend up and trend down, depending on whether the Chinese government wanted to speed up or slow down their economy. Now, what we expect to see is them use more the property market as that fiscal lever. There's always been concern that Chinese property is starting to slow, and I mean, there's many subplots there about whether they got urbanization wrong. Obviously, tier 3, tier 4 cities, there was an overhang in property 2 or 3 years ago. Much of that's been cleared. What you do have, though, is some big statements coming through from President Xi in his November Congress speech. He said, I'm going to eliminate poverty in China over this term. I'm going to reduce social imbalances. And he's making big reference to what's calling the social rental housing market. That's basically government-sponsored housing. And the Chinese government is worried that the volatility that comes through from the property market on their wider economy is causing too much cyclicality in downstream industries. So effectively, they're going to quasi-nationalize it and take a bit more control in that area. Therefore, you're going to see government-sponsored housing act as a counter-cyclical fiscal lever. If the Chinese industrial economy is doing fine, they'll be pulling back on that. And vice versa. If it's not doing well, you'll see them start to ramp up that spend. What it gives is a slightly more steady demand environment for commodities than we might have thought of the case 2 years ago. I just put up there on the right-hand chart. Q1 Chinese demand year on year, there was lots of concerns that maybe China was a little bit slow coming back from New Year, that with the NBC National People's Congress meeting in March, things weren't kicking up, but you look at it, steel, zinc, aluminium, all up between 4 to 5% year on year in terms of real demand in Q1. Copper, I have up over 10%. Much of that's down to the scrap import restrictions that were coming through, but underlying Chinese demand remains healthy, and if anything, continues to exceed our expectations. We're expecting this to slow, but it certainly still remains very strong, and that is the key driver and the key leader in any commodity cycle. Now, I talked about it. I mean, we're a situation where CapEx hasn't come back. We're starting to see it come back. I mean, so that's global mining expansion CapEx on the left-hand chart there. You see 2012, over $140 billion spent. Of course, that had more than halved by 2016, 2017. It's starting to come back, but I would say it's very selective. I think we have mining company boards throughout the world, particularly at the major companies, who are still conservative and will still be. I think mega projects, quite frankly, are off the table for the current time. I don't think you're going to see boards commit to long-dated, multi-billion-dollar CapEx, multi-year lead time projects anytime soon. So you are going to see some smaller projects come through, and what's interesting is we're seeing a lot more interest in some of the smaller commodities, if you want, in terms of CapEx spending. But what we've had is little growth ex-China across many commodities. I've put up the CAGRs there on the right-hand side. Stainless steel leading the way, but much of that's Indonesian stainless steel, which is also Chinese-owned. And you can see there we haven't seen much growth. Now, I think we're starting to move to a period where we'll have to see some more ex-China CapEx spent again to try and boost that output growth. Again, it can come down to trade frictions. It can come down to the fact that simply China's not going to export quite as much in some of these areas. Just to come back to the demand environment again for a minute. Global industrial production this year is probably going to have the strongest growth we've seen since 2010. Now, I suppose that's a little bit, I mean, it's a lot of last year's numbers, there's a bit of base effect there, but we have had this period where we've had really strong global industrial production growth. Whether you call it synchronized global growth or not, it's the industrial side has been doing very well. Now, right-hand side, PMIs. PMIs still are, your purchasing managers' indices are still your best indicator of real-time demand, if you want, or as close as you're going to get. Now, what you can see there is that they have probably peaked, and they're starting to trend down in some of these major economies, but they're still all positive. In every single major region of the world, purchasing managers' indices are positive. So the demand side is still good. It's probably easing a little bit. We're probably past the peak growth rates now of industrial growth, so that second derivative, if you want, it's getting a little weaker, but we're still growing. And we're still growing demand in an environment where supply, as I say, is lagging. That is helpful. It helps to prolong the price cycle and the margin cycle you see for commodities. Back to China for a minute. I mean, I just want to show an example here. We've had this trend basically since the start of the century where China's dominated refined production of all metals. Capacity has been added consistently in China because, number one, the cost of capital was generally cheaper. Secondly, that's where the end demand use was. Now, the Chinese business model was pretty clear. Buy raw materials, build, more than enough process capacity to process those raw materials and ideally export some as a bit of an inflation hedge. What you're seeing now is, of course, that encouraged a lot of, let's say, misinvestment, if you want, and an overinvestment in some refined capacity over the years. And actually, the Chinese government's now saying, well, hold on, do we need to do this? Steel industry is probably leading the cycle here. You've seen China cut operating steel capacity for the first time in early last year. And from that point, Chinese steel exports have halved. That's why steel margins are doing a lot better. That's going to, we've now seen China do one in, one out for aluminium capacity. You're likely to see Chinese aluminium exports fall. And again, the world's got used to those exports. Copper smelting, China's adding a lot of copper smelting capacity at the moment. Again, I expect that to go towards one in, one out for capacity next year. So I think this trend in China's share of global refined production is actually going to start easing and, if anything, reversing over the coming years. This is a big change in wider commodity markets. I talked about oil a minute ago. I mean, what oil does is tend to steepen commodity cost curves. Everyone's costs go up, but those who tend to have the better in-situ grades, the better assets, are naturally at the bottom end of the cost curve. Those with the more marginal assets at the top end. Bulk commodities are naturally more affected by the oil price. If you think of it, simply digging rock out the ground, putting it on a diesel truck and a bunker fuel vessel and sending it to China is naturally going to be more oil linked. There's two reasons, though, we're seeing cost steepening. So the left-hand chart looks at the difference between the 25th percentile and the 90th percentile of the iron ore cost curve. You see in 2011, 2013, we needed every single unit. We were attracting a lot of incremental supply onto the top end of cost curves. That was removed as the iron ore price fell. Now we're seeing that steepening coming through for two reasons. Number one, oil price is rising, which again serves to steepen the cost curve. It's a benefit to those with low-cost assets. Secondly, you're seeing quality spreads increase. It's been talked about a lot in the iron ore market, but of course that differential between lower grade and higher grade is wider, and I think will stay wide for a while, and I'll talk about that later. But the right-hand chart's an interesting one. This is the current price versus the 90th percentile of the cost curve, which is always what commodity analysts have lent on for let's say, mid-cycle equilibrium in the past. Pretty much across all major commodity markets, we're trading out that cost curve. What does that tell you? We're trying to attract every available unit of supply into the market. Now, that, again, points to the fact we're still in a good demand cycle. Now, when the demand cycle eases, you would expect to see us trade back towards that top end of the cost curve, but at the moment, for some of these commodities, we're still trying to attract supply into the market because CapEx-led supply has not reacted in the same way this cycle. And also, we've lost the Chinese private sector mining industry, which played a very important role. I can't overestimate, can't overemphasize what an important role the Chinese private sector mining operations played. As I say, their cost of doing business has gone up so much that we're not seeing the reaction we've seen from them in past cycles. Just talk about the longer term trends. I mean, there's two trends when you think about demand for commodities. I've just used copper and steel here as an example. There's population growth, which continues and is a nice annuity, if you want, for commodity demand over time. Kilogram per capita can stay flat, but if capita is going up, then your kilograms have to go up and your consumption. Then you have the penetration side, and that's more driven by the cycles of urbanization and industrialization. And you see we've been through, I mean, still quite a strong period. And it's interesting, if you look at the right-hand chart, we still see actually some decent growth there in penetration rates for copper. Maybe a little bit slowing down in steel. But again, we can talk about some of the reasons for that further on. Now, why is there so much focus on China? I mean, just to put it in metrics, that's Chinese steel consumption just in the property sector. And I've compared it there to total steel consumption in the US, in Europe, and in Japan. Quite frankly, it's still going to be the case for the coming years that if you get China right, you will get commodity markets right. China is still the most important demand driver over the coming years. Though, of course, we do have this trend, and the biggest swing factor on certain markets is the residential floor space per capita, certainly for the steel market. And you can see there the path that China has followed. Of course, we're going to see more of these one belt, one road type countries pulled through that same trend over the coming years. I've taken this chart from Oxford Economics, and when we talk about construction, there's also the infrastructure sector as well. And this is taking I mean, the trends we're seeing in global infrastructure spending. Now, what do we know? Many developed economies in the world have probably been underspending in terms of infrastructure in recent times, and we need to see a pickup there. And it comes across many areas, but this is something that again points to slightly healthier demand growth conditions over the coming years. So this underspending, I mean, it's been going on for a while. I mean, US infrastructure, of course, has needed spending for 40 years. Part of the challenge is now with import tariffs, the cost of doing it is about, or certainly the steel part of it's 25% higher. But you are likely to have to see some catch-up coming through there. Now, infrastructure, of course, can swing around as the area as it goes. Obviously, we have trends coming through of greater use of electric mobility. Utility structures are changing. But still, I expect that to be this is again one of your annuity drivers for commodities over the coming years. And it's worth thinking about, I mean, what's happened? This is the growth in market size from 2000 to 2017 across many of these key commodities. And if you look at it, steel, iron ore, aluminium, more than doubled in market size compared to where they were in 2000. Some of the base metals between 50 and 100%. Gold, 19, lagging a bit, but of course, that means we're having to support an asset base now that's considerably larger than it was at the turn of the century, and that naturally plays into more projects needed just to hold us at the same level. And sustaining capital, if you want to term that sustaining capital, therefore has to rise. And of course, in many cases now, we're having to look to incrementally poorer assets than maybe the ones that we were bringing on 20 years ago. So it's more pressure on the supply side. Of course, you can't do a commodity presentation these days without talking about electric vehicles. Electric vehicles are the area that, I mean, certainly relative to market cap, if you want, take up a disproportionate amount of questions that come to me at the current time. There's many different areas of this. Now, it's a trend that, of course, we're now at the stage where that penetration starts to really pick up. I think there's uniform agreement now that we're at that point where you're getting the inflection, obviously with Chinese sales, for example, are more than 100% year on year. What's interesting for me is there's still a disconnect out there between downstream and upstream in this sector. The auto industry are still, in my view, were panicked into targets in the post-diesel emissions scandal, and they're now backfilling that with strategy. Now, because they're only now thinking about the strategy side, they haven't thought about the impact on raw materials. And generally, the auto industry has been used to industries that service them investing through the cycle. Of course, that hasn't happened in the mining side, and that's why we're looking at more raw material constraints coming through. I think there's many things. There's two things about electric vehicles in terms of the impact on raw materials. If we think of just the batteries themselves, there's EV penetration. There's many forecasts out there on rates. We look at a 10% EV penetration by 2025, but I mean, there's a whole range of numbers out there. The second thing, which is equally as important, is the battery size itself. Bigger batteries in the same vehicle obviously use more raw materials and get you into raw material constraints faster. Naturally, there's going to be development here that is going to solve for constraints. That's the way manufacturing tends to work. Now, when we look at it, a couple of things. To reduce the cobalt content of NMC batteries below 20% is to cause a big stability problem. So in our view, trend is going to be more towards, let's say, NMC 622 type batteries that still contain 20% cobalt. We think for major automakers, the Chinese subsidy policy is pushing people towards higher nickel, higher energy density, and certainly there's a trend there, and we see that is an ongoing trend. But I would say that there will be a limitation there from the amount of cobalt that gets substituted, particularly for developed world automakers. Cities have the greatest potential for EV penetration. If we look at where EVs have worked so far, those with the highest rates, it's Netherlands and Norway. And there, electric vehicles are used as commuting vehicles, mainly for city operators, and the second cars. If you want to go to your lodge at the weekend, well, you've probably got an ICE engine that will do that. But when you use EVs in cities, of course, you don't have the same range anxiety problem. At the moment, you've got battery companies trying to make batteries bigger forever. That runs into raw material constraints quickly. I do think there'll be a trend towards smaller batteries and a more diverse portfolio of autos coming through. Cities, of course, I mean, have the biggest pollution problem, have the greatest ease of building infrastructure, and also have the tax structures to incentivize use. I put up there on the left-hand chart the demand from 1 million EV batteries as a percentage of current market size. You can see lithium has the biggest impact, closely followed by cobalt. Now, of course, cobalt, I would say, is probably the major area of constraint because it can't fund its own projects. It's naturally a byproduct of copper and nickel, and as any cobalt project is probably going to be more driven by long-term copper and nickel prices than by cobalt prices themselves. Let's go talk briefly on a few commodities. Now, copper, one of the major ones. This is that left-hand chart there. Look at the copper project pipeline. We've never had so few copper projects coming through the pipeline, either probable or highly probable, this century, either in terms of number of projects or capacity. Analysts have been calling for a copper deficit. They've always said it's 3 years away. It's always 3 years away. I would contend now that it's about 12 months away, and therefore there's nothing the mining industry can do about it. Now, if you do an unconstrained market balance, of course, you get into massive deficits. One thing about commodity markets is you have this habit of self-solving. Market deficits like that simply do not happen. So we have to think about what will happen in copper. Price has to act as your regulator. And the price was likely to go to a level over the coming 12 to 24 months that will attract supply back from places we never thought about, that will see all potential scrap come back to the market, and will also probably destroy some demand or accelerate substitution processes again. And for that, we look at a copper to aluminium ratio of about 4 to 1. Now, if you look at aluminium now at $1 a pound, $2,200 a ton, therefore that points towards a path to $4 copper. Not as a sustainable price level, but certainly one we may see, because I don't think there's anything that the mining industry can now do about the supply deficit that's coming through. Post-Cobre Panama, which is the last of the big mega projects, there is a 2 to 3 year gap before you see many more projects coming through. 2 areas of growth for copper: Chinese smelter output, and as I say, I do think that will, the Chinese government don't like industries that invest hard in capacity and then don't make money, so I do expect them to see them move towards a one in, one out for copper smelting capacity into next year, but also electric vehicles. Electric vehicles and indeed renewable energy. There's always a focus on copper supply, but actually I think you can make a good case for above-trend copper demand growth over the coming 5 years before substitution effects come through, on the basis that we're going to see China push hard into electric vehicle charging. If you look at that red dot on the right-hand chart, that shows the number of charging stations in terms of penetration per capita on the right-hand axis that China is aiming for by 2030. It's 50% ahead of the industry leaders at the moment, which are, as I mentioned before, Netherlands and Norway. There's a lot of copper needed to support that infrastructure. Aluminium, I mentioned before, I do think that exports are falling. I think this is about 18 months behind steel in the wider commodity cycle. And what I think you're likely to see, Chinese aluminium production growth, expectations have been pulled down over recent years as the Chinese government's attitude towards new capacity has changed. And all things being equal, if production is not growing as fast, if demand's still pretty good and penetration rates for aluminium continue to increase in areas like construction and packaging, then it means exports have to fall. So I think it's about 18 months behind steel in the wider commodity cycle. There's been a lot of noise about that market in recent times through sanctions, through tariffs. I think this is the actual key fundamental secular driver of the market. Precious metals, they're still driven by macroeconomics more than anything else. Gold you have to think about as a framework, but the one thing that drives gold prices now on a shorter term basis is money market flows. Effectively, if you look at a combination of futures positioning and flows into ETFs, that is the driver of the gold price these days. Gold less driven by physical demand, even less driven by, dollar and interest rate expectations than it was. It all comes down to asset allocation. Macro asset allocation is still pretty decent given the geopolitical risk we have in the world. Micro asset allocation, i.e. the retail investment, has been lacking. Obviously, we're at the early stages of an inflation cycle coming through. Generally, that tends to be where you get a bit more retail investment coming. Of course, silver, gold-silver ratio is now at 80 times. That is a stretch relative to history. Long-term history is about 62, 63. Silver has been disappointing for many of us over recent years, but it does now have a growth driver in terms of industrial demand, as photovoltaic cells start to pick up. So the decline we've seen from silver use in photography is more than offset by the growth we're seeing in use in photovoltaic cells, or solar panels, over the coming years. Iron ore, well, I talked about Chinese private sector mining before. None of us were expecting Chinese iron ore output to be this low. And this is in what's been quite a good price environment. So again, that highlights the clampdown you've seen from the Chinese government and on private sector mining. And also to talk about the second factor I mentioned before, the quality spreads. Basically, the Chinese steel industry will be operating at higher utilization rates going forward than it did over the past 5 years. Blast furnace is a fixed volume. The more you can get, the more iron you can get in there, the better. And I do think that while steel margins remain strong, you'll continue to see a wider spread and a bigger premium for quality material in iron ore, and also the other bulk commodity markets of manganese ore and metallurgical coal. Just lastly, I think, on cobalt, I mentioned it before as a constraint. Of course, you cannot get away from this power axis, as I'm calling it, from DRC mine output to China chemical output, and China dominates production of cobalt chemicals, of course, therefore into battery demand. Now you can see the cobalt market is tight already, with basically nothing going into electric vehicles. Obviously, we're expecting this growth to come through over the coming years. To make way for that, we have to substitute. So cobalt, from a commodity analyst point of view, at any given point in time, I'm having to make pretty aggressive assumptions to try and bring that market back into balance. I'll just leave it on this slide, which is our commodity comparison chart, if you want, a little heat map for where we see it. I mean, the x-axis is potential for a long-term shortage, y-axis is potential for short-term constraint. Obviously, the further right and the higher you are, the better in terms of the commodity exposure. I do think it's still a good period for commodity markets. We may have passed through the peak of industrial growth, but demand's still there and supply's still lagging. And that does point to a period of healthy pricing and trading out of cost curves, certainly for this year and next. Thank you very much.
Are there any questions for Colin, just while we have a couple more minutes? Does anyone have any questions about any commodity choices or anything that we've seen up there today?
I'll answer questions on Scottish football, anything here.
There's one here.
Hey, Colin. Wanted to ask you what's your, you have the commodities on the right. Are they really the top commodities you have of choice, or you have one in particular?
So you can see there that the cobalt is, is top and right there. And the reason for that, as I say, the aggressive assumptions I have. I don't like inventories being below zero. That doesn't happen. So I have to find ways of balancing markets, because commodity markets, as I said before, always self-solve. The aggressive assumptions I have to make in that market mean that at any given point in time, I'm having to really substitute hard, both in terms of cobalt use in batteries, cobalt use in things like artificial hips, for example, cutting tools. That has to go to zero just to try and make way for the EV growth that's coming through. Now, others, you look at more the trends in supply constraint. Why do commodity analysts always like copper? Because basically we knew about every asset 20 years ago, and the good ones were mined then, and any incremental asset is probably lower grade and higher geopolitical risk on average than the existing asset base, so it's dilutive, and that should lead to a steepening cost curve over time.
Two questions, Colin. First one is on cobalt. Do you think the next couple of years we'll see a lot of oversupply because of the ramp up in DRC? And second, what are Greenock Morton's chances next year?
The second question's relegation fodder. That's the answer to that one. The first question, there's a lot of investment in the DRC going in. Of course, I think Glencore, with the Katanga operations, that's 30% of current cobalt market supply they could bring over the next 24 months. Much of that's tied into long-term contracts, so it's not free-float cobalt, but it is cobalt units coming to market. So I have a deficit in the cobalt market for this year. That gets solved as we move into next year. Cobalt price has gone up fourfold. We're now at a level where we will be driving some of that substitution coming through. So for me, I do think I do think we're starting to solve that cobalt process. Now, it's interesting. I do think there's, what you're seeing is a lot of smaller scale cobalt. I mean, probably quasi-artisanal cobalt coming out. The sulfuric acid price in the DRC is now $500 a ton, which tells you that people are trying to push SXEW processing pretty hard.
Hello there. In relation to your graph here, where does gold and platinum sit?
So, of course, I put this up as a fundamental commodity graph, and this is part of the problem. Now, it's Platinum Week this week. The platinum industry has a problem for two areas. Well, two areas of problem: Chinese jewellery and diesel, generally. And the demand side is an issue. If you look at the rand price for platinum, it's now around 11,500 rand per ounce. That's a pretty tough price, and we should be seeing more rationalisation of the supply side. What I'd like to see the platinum industry do is more accept the challenges, shall I say. Because if we look at commodity markets that are bad, producers normally go through the denial stage, the acceptance stage, and then the action stage. Platinum hasn't yet come to the action stage. I would like to see them push harder in terms of the demand. I think there's a good opportunity in fuel cells for the truck industry in particular. I'd like to see them push harder looking at that area and market it more. I think obviously from the supply side, there is probably a need for some rationalisation. We've seen some producers present this week. They say they're going to take action, but as of yet, there's not been much. In terms of gold, of course, you're never going to have a long-term shortage because it's all still above ground. However, what gold has lacked, as I say, is the retail investment side. I do think there's a period coming now where you will see actually macro and micro aligned on the positive side for gold. Now, how long that lasts, we'll wait and see. Depends on where that US yield curve ends up. My concern is you lose the macro for gold at some point. You lose the asset allocation level towards gold flowing into the ETFs, for example, if we are to go into, if there is greater expectations of a further Fed hikes and a steepening yield curve coming through. But at the moment, you should be starting to see some of that retail demand coming back through.